Welcome to FX Tech, your source for professional Forex analysis. This week, we're breaking down the USD/JPY pair for the period of November 24th to 29th, 2025. We'll cover the critical news, key technical levels, and actionable trading strategies to help you navigate the market. The dollar-yen is at a major turning point as Fed rate cut expectations clash with the Bank of Japan's policy stance. Stay tuned as we dissect the price action and provide our outlook for the coming weeks. Let's get started. This week, the USD JPY saw a significant reversal, falling 0.8% as broad-based dollar weakness took center stage. The pair opened around 157.50 but closed near 156.30, marking a 120 pip loss for the dollar. The primary driver was a dramatic surge in Fed rate cut expectations, which jumped to 86%. This move broke the aggressive uptrend that has dominated for months, pushing the pair into a new consolidation phase. The market is now digesting this shift, creating a period of uncertainty and opportunity. Here's the game changer. The market is now pricing in an 86% probability of a Fed rate cut on December 10th, a massive jump from under 50% just a week ago. This dovish pivot sent 10-year Treasury yields below 4% and knocked the DXY index down from 100 to 99. The narrative has completely shifted from indecision to strong expectations of monetary easing. This was the single biggest driver of the dollar's sell-off and the yen's corresponding strength this week. Fueling the Fed's dovish narrative was a string of disappointing U.S. economic data. Retail sales missed expectations by 50%, coming in at 0.2% versus 0.4% forecasted, signaling a slowing consumer economy. Additionally, core PPI, a key measure of producer inflation, moderated to just 0.1%. This combination of weak consumer spending and cooling inflation gave the market the confidence it needed to fully price in a December rate cut, reinforcing the dollar's weakness and putting the yen on the front foot. Here lies the paradox. Despite a 55% probability of a Bank of Japan rate hike, the yen remained relatively weak on a structural basis. Why? The massive 350 basis point interest rate differential. With the BOJ at just 0.5% and the US at 4.00%, the carry trade still heavily favors the US dollar. While short-term yen strength is visible, the long-term risk is that if the BOJ fails to deliver a meaningful policy shift, this yen strength will quickly fade and the structural uptrend will resume. These are the levels you need to watch. The most critical resistance is the 2025 high at 158.21. A break above this level is required to resume the uptrend and would target the 160 psychological barrier. On the downside, the major support zone lies between 151.88 and 153.30, which aligns with the 50-day moving average. A close below the 155.00 handle would confirm a deeper correction is underway, making these levels the key battlegrounds for bulls and bears. For the next 1 to 2 weeks, our outlook is neutral to bearish. We expect range-bound trading between 155.00 and 157.88, with the path of least resistance pointing downwards. The recommended strategy is to sell rallies towards the top of this range, especially around the 157.50 to 157.80 area. A definitive break below the 156.00 pivot zone would increase bearish pressure, making the 155.00 level the next logical target. Expect elevated volatility with key U.S. data releases ahead. Over the next 1 to 3 months, our outlook is cautiously bullish, but with significant uncertainty. The 350 basis point rate differential provides a strong fundamental support for the dollar. However, a fresh catalyst is needed to break the 158.21 resistance. We assign a 60% probability to a bullish breakout targeting 160.00, but this is highly dependent on the Fed's decision on December 10th. A firm rejection at resistance could lead to a 40% probability of a correction down to the 152.00 to 153.00 area. Here's how to manage your risk. 3 high-impact events to watch: a surprise hawkish Fed, a concrete hawkish shift from the BOJ, or hot U.S. inflation data. Our primary strategy is to sell rallies at 157.50 to 157.80 with a stop above 158.30. For those looking to buy, we advise extreme caution, waiting for a dip to the 153.30 to 155.00 support zone with clear rejection signals. Alternatively, breakout traders can wait for a daily close above 158.21 to go long or below 155.00 to go short. To summarize, the USD JPY is at a critical juncture. The week saw a 0.8% yen gain as Fed rate cut probability surged to 86%, breaking the pair's aggressive uptrend. The market is now consolidating between 155.00 and 157.88. Our short-term bias is neutral to bearish, while the medium-term outlook remains cautiously bullish, pending a break of 158.21 resistance. Keep a close eye on the Fed's December 10th decision and upcoming U.S. core PCE data. Thank you for watching, and subscribe for more professional Forex analysis.